here's the deal. I have a 30-minute presentation to give you in 20 minutes. So that means I'm going to talk super fast. I have a ton of data, a ton of charts, a ton of price predictions, and I'm going to go through it super fast, and you guys are going to wish I could slow down. But if I get to the end fast enough, at the end there's a QR code and you can download all my slides. First off, let's think about this resource revolution. So I was just talking with Nick before I came up here, and I was thinking about, if you think about resources and specifically gold, here we are at a gold conference, and when I think about that, like if you think about it from a first principles level, what were the things that caused gold to become money for 5,000 years, the best form of money we've ever seen? How did it evolve to that level? What were the attributes that made it that? And if you can understand those things, then you might understand this next level. Now, when you look back through history, you always see that it's always technology that changes the world. Because technology changes the way that we move, interact, and things like that. And so things evolve and things change. And I want to show you what I'm calling the quantum wave. So about every 50 years, the world changes. All right, let's go through this really quickly. Okay, so about every 50 years we see this. I call it a quantum wave. Now, if you're in technology, you might have heard it called like a K wave. I call it a quantum wave. And the reason why I call it that is because the world changes, not just the entire direction of the world changes, but from a financial standpoint, it changes as well. Now, when you see pattern recognition, you realize that the more times a pattern repeats, the more likely it is to repeat again. Sort of like the Lindy effect, not exactly. So when you see a pattern repeat 2 times or 3 times or 4 times, the chance of it happening a 5th time is very likely. Well, in the quantum wave cycle, we've seen that it's now happening for the 6th time. So about every 50 years, we see the world leap forward. Industrial revolution, the first time we saw mechanized machines. We went to steam engines, railways. Then we went to steel, electricity, heavy equipment, went to oil fuels, automobile, mass production, things like that, 1908. And then 1971 was the birth of the microprocessor, which brought personal computers, telecom, and the internet. Each one of those represented a massive shift forward for humanity. But more important than just a shift for humanity in the way that the world worked, what we also saw is that each one of those represented the chance to build generational wealth. The only place to build wealth and invest, really, if you wanted a lot of wealth, over the last 50 years has been personal computers, telecom, and internet, represented by Jeff Bezos. Before that, it was automobiles, Ford, GM, GE. Before that, it was steel, it was oil. And so each one of these represents this what I call the investing black hole. It's really the only place to build wealth. So not only does the world change because of the technology, but from an investment standpoint, it does as well. Now, to understand these 50-year cycles, we can see that, again, through history now going to the 6th one, they happen on a very predictable pattern. There's 4 distinct phases within that, and broken down over these 50 years. The first one is the Big Bang. The new technology was created. Oh my gosh, look what we have here. We just turned oil into fuel. Now, we can build combustion engines. Or, oh, look, now we have electricity. We can have light. That's pretty cool. So you have this Big Bang. Now, it's important to understand this technology takes over sort of from where the last one ended. So we have the Big Bang, the eruption, we go into the frenzy. As you can see, I've put some green arrows on the chart that sort of illustrates and highlights where I think we're at today, the synergy, deployment, and maturity. And right around that time is when the next one is going. So when you understand that each of these 50-year cycles, going into the 6th one now, happens in the same dependable 4-year cycle, then you can start to map out where we're at today and where we're going from here. Okay, now what happens is, I said, this new technology is taking over from where the old technology left off, and more importantly, the shortcomings of that. And so what we saw back to the birth of the microprocessor, personal computers, telecommunications, and the internet, is the internet started very decentralized. Any of you guys old enough to have been on the internet in the 90s? A couple of you? So in the 90s, in 1999, I thought I was really smart in California. Silicon Valley was blowing up. We had the dot-com boom going, and I decided to start this internet company. And at that time, I had to build a server rack in my office, and I had my own servers with RAID 5 hot swappable hard drives because it was decentralized. In order to get on the internet and have an internet business, I had to run my own server in my own office. But what's happened is, obviously you guys know that the world has become very centralized, and now we're logging in with our Facebook ID and our Google ID, and all of that centralization has led to manipulation of the data. We can no longer trust the algorithm and all those types of things. So the centralization is failing, and we can see that decentralized systems are now picking up steam, and that will continue over the next 50 years. So I've sort of mapped out the time frame that this is happening, 2010, 20, 30, 40, and the full cycle should be completed by 2050. Now, these are not exact time your watch to the date, but these are approximate time frames that we see this happen over time. Now, when we understand monetary history, back to the commodities that we're all here talking about, when we look at monetary history, we can see that those are also an evolutionary process as well. And so there's all types of things that have been money over 5,000 years, from feathers, rocks, and seashells, and cowrie beads, to, of course, gold emerging as that. But we understand that there's a process that happens, and there's sort of this Darwin process of survival of the fittest. So some things become as a collectible, like look at this cool feather, rock, or seashell. But only some collectibles ever make it to the next stage, which is becoming a store of value. So today, a lot of wealthy people store their wealth in collectibles, like fine art, old cars, jewelry, some baseball cards. Not all baseball cards become stores of value, some do, and etc. Now, if the store of value becomes used big enough, and it has the right moneyness attributes, back to what made gold successful, then maybe it could go from a store of value to a medium of exchange. Maybe. Most of them don't. So what are those attributes? Portable, durable, divisible, recognizable, saleable, right? So gold had the best attributes, as well as scarcity, to become that medium of exchange. And then if that medium of exchange becomes used enough, it can become a unit of account, where goods are now priced in that asset. We understand that? So not everything makes it there. Of course, you wouldn't use bananas as that because they're not durable, and you wouldn't use a Mona Lisa for that because it's not divisible, but we understand how that works. Now, what happens is we need to understand that these cycles of technology happen in a predictable time frame, and we need to map this out. The reason why this is important is because we don't understand the time frames if we don't. So, for example, a lot of people miss what's going on because they're expecting way too much too soon because they don't understand that this rolls out in a predictable cycle. Okay, so phase one, I'm going to go through this one super quick. This is history. And the reason why I want to set the stage with history is because when I show you the future, you're not going to believe it. But if you understand the history, you'll understand the future is believable. All right. So phase one was this retail eruption, right? So this is the Big Bang. The technology just came out. And this is where retail kind of comes in. This is the true believers, the total nerds. They come in, they start playing with it, they have fun, okay? In this phase, Bitcoin, this new resource commodity, which I'm going to show you where it's going to, was a collectible. Oh, what is this? Kind of magic internet money. Kind of cool. Probably would never be nothing like a Pokemon card or like a Beanie Baby, but like I like it. It's collectible. All right, during that phase. Now, during that phase, we saw it being used as a collectible. Here we have the famous case of 10,000 Bitcoin being spent on a pizza. It's just a collectible. Let's see if we can just trade it for something of value. That was the whole experiment at the time. And we can see that during this period, it's important to understand with technology, during this period, there's limitations to the technology, and it creates experimentation. So what happened in 2017, there was this famous block size war where this battle over the control of Bitcoin laid out because it was this collectible, but was it becoming worth something of value? Now, what we can see that the end of this phase in 2020 with this stage called NFTs. Anybody heard of that? Remember those NFTs? Non-fungible tokens. And so everybody thought, oh, we're going to put art on the blockchain, and we're going to have these JPEGs, and they're going to be worth a lot of money. Not really. It turned out not to be the case. Now, it made a lot of money during that time because they thought we were putting collectibles onto the blockchain. And that's fine. That's where we were in phase one. So it's not that it failed. That's exactly on pace. That's exactly where we're supposed to be. Now we can see the chart on the right shows the explosion of the NFT explosion going straight up and straight back down. The market's now 97% of NFT projects are dead and they're never coming back. That's like a tulip bulb. Pumps go up, dumps come down, and then it's dead. NFTs were not it, but it was the necessary first step. Now we can see that the second stage of the store of value had started to be seeded. Oh, I'm going too slow. All right, let me see if I can go faster. I just want to show you this chart. So from 2010 to 2020, This is a chart of what we call store of value assets. These are assets that you park your wealth into. So this is gold, collectibles, equities, real estate, bonds, and money. This is just where you save your money. And we can see, we need room for those people in the back so you can see the charts. Come on in, there's plenty of room in here. A lot of room on this side. Okay, so we can see like gold, for example, went from 5 trillion to 11.5 trillion during this time frame, more than doubled. Equities went from 50 trillion to 95, real estate from 180 to 320, bonds 80 to 300 trillion during this period. Now, it's important to understand this so we can see. So the total store of value assets went up by about 8.4% during this 10-year period. Okay, now during this time, Bitcoin went from $1.5 million market cap to a $500 million market cap, a gain of 4,426%. Okay, by about 8.4% during this 10-year period. The frenzy phase. And this is where like it's kind of been proven out. It's starting to grow some legs, and now the real money is starting to go, what the heck is going on over here? Let's go check it out. Now, I put the green arrow. This is sort of where we're at. Not only are we in this frenzy phase, this is where this now asset is moving from just some weird internet money collectible to becoming a true store of value. Larry Fink, the head of BlackRock, the largest asset manager in the world, went on CNBC about 6 months ago and said it's time for everybody to realize this is a true asset. And now BlackRock, a couple months later, is recommending a 5% portfolio allocation to everybody in their portfolio. Most people will own Bitcoin and don't even know it because BlackRock just manages your retirement fund for you. Now, it's important to understand that it's not too late. The majority of the growth comes in phase 2. So when it looks at technology, we use something called an S-curve to measure the adoption of that cycle. And the way an S-curve works is that green S line that I put there. The time it takes to go from 0 to 10% adoption is the time it takes to go from 10 to 90% adoption. So if it takes 12 years to get to 10%, it takes 12 years again to get to the 90%. That part is the straight up parabolic move, and this is exactly where we're at. Now in this part right here, today you can see that Bitcoin is represented and next to store of value assets as a little tiny drop in the bucket on the right-hand side. I have a venture capital fund. We invest into early stage companies. And the way that we value the potential of those companies is by looking what markets is that company disrupting, and what do we think is a reasonable percentage to take or capture from that market. Uber took value from taxis and limos and vans. So this is what Bitcoin is drawing value from. Bonds, real estate, equities. Now, right now, it's a little tiny blip in the bucket, and the goal is to see how far that can progress. And I'm going to project it out for you. We can see this here, 60 publicly traded companies today have Bitcoin on their balance sheet. So we can see the frenzy institutions. We see sovereign nations are now frenzied into it. So started with El Salvador, but now lots of nations, about half a dozen nations are talking about it. Most likely here in the next 100 days, Trump is going to announce it for the United States. And many of you maybe are sleeping on what that means. In the world of economics, specifically in investing, it's a very competitive game. If a fund were to acquire a strategy that outperformed the rest of Wall Street, every other fund is forced to adopt that. When a country like El Salvador adopts Bitcoin, the poorest nation in the world, it doesn't really influence a lot of countries. But if the United States does, what do you think happens? What do you think happens to the G20? What do you think happens to that race? I'll skip past that. Why are they all frenzied into it? Well, this is the answer right here. We can see that I'm showing the United States. I'll show you some other ones. But right here, the money supply in the United States over the last 4 years has been growing by 13% a year. It's not 3% like they tell you with CPI. The rate of the money supply, you guys are gold people, you know that inflation is the increase of money supply, 13% a year. That's the inflation or the hurdle rate. Now, will this continue, might be a question I would ask. Well, the government tells us it will. The CBO, Congressional Budget Office, projects out the budget for the next 30 years to 2054. And what they're telling us on the bottom, well, the top right is the population is going down at a very rapid rate. When we don't have as many new people working, then GDP goes down, the bottom right chart. So population's going down, GDP's going down, and if population and GDP goes down, then how do we continue to pay for things? Well, the top right shows you that their projected deficit is continuing to get bigger and bigger and bigger. Not smaller, bigger and bigger and bigger. And then how do we pay for that continuing deficit? Well, the bottom left chart shows you the projected debt levels, like a hockey stick. So Will that continuation of monetary expansion continue at 13%? Well, per the CBO's, the Congressional Budget Office own chart, it shows it's going to go at an even expanding rate than that. But let's not even use that number because it's too aggressive. Let's go to a smaller number. So if we project that the monetary increase is from 2020 to 2030 is only 8%. We're averaging 13%. CBO says it will increase, but let's just use 8%. That means the total bucket of store value assets will go from about 850 trillion to 1.679 quadrillion. Real estate goes from 320 trillion to 700 trillion. Gold goes from 11.5 trillion to 20 trillion. And Bitcoin, I believe, goes to 21 million. And that's only taking 1.25% of that bucket, only 1.25%. Now let me put this into some numbers that might make sense to you. When Uber and Airbnb launched, they were able to capture or take over 10% of their respective markets in less than a decade. 10%. This is only 1% in 25 years. Let's keep going. All right, because I'm running out of time. That would put Bitcoin from a $500 billion market cap today to a 21 trillion market cap, puts it at $1 million per Bitcoin. For those that are slow in math, that's a 10x from today at only capturing 1% of market share. Okay, now that would put Bitcoin on par with gold, as you can see on that bottom right part of that chart there. Again, this doesn't mean the dollar dies, doesn't mean assets go away. It just means that it's just capturing a little bit. Just like there's still taxis at the airport today when I flew in yesterday, and there's still hotels that I'm staying in right now, even though there's Airbnb and Uber. Okay, let's keep going. 2030 to 2040. Now this is, some gold guys might understand this analogy. This is where we get to the adoption synergy phase. Now a lot of people want to ask me, oh, this is where we go from a store of value stage, again 2030, into finally becoming a medium of exchange. There's way too many people out there that say that Bitcoin has failed, Mark. Where can I go use it? I don't know. I mean, it obviously doesn't work. On the Bitcoin white paper, it said it's supposed to be peer-to-peer electronic cash. But show me where I can go buy a cup of coffee with it today. Well, you can in El Salvador. But where can I do it widespread? Why can't I spend it at the grocery store? Well, you guys are gold people. You should understand this. You understand something called Gresham's Law? Anybody ever heard of Gresham's Law? Gresham's Law, if you're gold guys, you should know that. It's that good money drives out bad. The bottom right picture there, the quarters and dimes, anybody know what that is? Junk silver. Anybody own junk silver? Bags of junk silver? You do, right? That's pre-65 quarters and dimes were made of pure silver. You don't find them in circulation anymore. If you happen to get one by accident, would you spend it? The answer should be no. You would save it, right? Because the good money drove out the bad, right? So we would rather spend the post-65 quarters and dimes. We're going to save a pre-65. But then why do you own those bags of junk silver? Because you believe there could be this age where I might need to barter, and the bars and the rounds that I own are too big, and so I need smaller denominations to barter. So what you're saying is, I would only use that if I needed it for something that I couldn't use the existing system for. That's what you're saying, right? So we have to understand, Bitcoin hasn't failed. It's that I'd rather just use my fiat dollar to go buy my cup of coffee today and save my good money. So then when will we use it? Well, I'm running out of time, so I'm going to go through this pretty quickly. We have to understand the attributes of it. And so it's faster and cheaper. It's borderless, permissionless, censorship resistant. It's immutable. So what types of things would I need that for? Well, if I lived in Afghanistan where women can't even have a bank account, it'd be my only option. If I lived in North Korea where you're not even allowed to have money, that might be my only option. But what about fast and cheap? What about borderless? 1.5 billion adults in the world today have no access to banking. What about them? But more importantly, how do we send 35 cents across the internet today? You don't. It's impossible. You can't do a microtransaction. What happens if I traded sent a dollar back and forth across the internet? What happens if I traded $100 across the internet back and forth 1,000 times? It's gone in fees. But we have the rise of AI, and more specifically AI agents that's popping up right now, and they are doing microtransactions at a level and speed that we can't even understand, and they can't use the fiat monetary system. It will not work, just period. The AI agent market is expected to grow by 40% CAGR over the next 10 years. And that will start to push the adoption of it. It has an asset it can use today that the fiat system can't be used for. So I project by 2030 to 2040, the entire store of value assets to grow from 1.6 quadrillion to 3.5 quadrillion, and that's only at an 8% increase of the monetary supply, which I showed you the CBO projected to go up at double that. Gold goes from 20 trillion to 32 trillion. Bitcoin goes from 21 trillion to 289 trillion. That's capturing 8% of the total store of value assets. 8%. It's not unreasonable. Way less than Uber and Airbnb got of their respective markets. At that rate, that would put Bitcoin at $14 million per Bitcoin by 2040. That's 15 years from now. And it looks like this. It's now surpassed gold, surpassed collectibles, and now it's one of the larger asset classes that's out there. I'm going to skip through this. Finally, we get to the maturity phase, and this is where it becomes a unit of account. It's now surpassed the medium exchange phase, the unit of account. Now, what we've seen over the last several years is everything's been getting more expensive. Everyone's getting priced out of the market. How do my kids afford a home? They're not going to be able to afford a home. I can't afford gas is like maybe the number one issue in the presidential election in the United States. Pretty big deal here in Canada as well. But while homes are getting more expensive in dollar terms, they've gotten so much cheaper in Bitcoin terms. In 2016, the U.S. median home was $200,000. Today, it's $450,000. But it was 400 Bitcoin in 2016, and today it's only 3. What we can see is that as prices of oil and gold and S&P 500 and houses all go up, in the last 5 years, they've gone down 90% priced in Bitcoin. Eggs, cheese, beef, soybean, wheat, lumber, milk have all gone down 90% or more when priced in Bitcoin. When you just change your unit of account, life gets easier. So the world is supposed to get easier. What we want is our money to buy us more things in the future instead of less. Now, the famous example of gold is that the same amount of gold buys you the same amount of goods today, right? I can still buy the same amount of the same suit for the same amount of gold. That's cool. I want my money to buy me more goods and services, not just keep up. How about buy me more? That sounds better. I want my life to get easier. I want to work less. I want to experience what technology is supposed to bring us. I'm supposed to have robots cleaning my house. I'm supposed to have computers doing my work for me. Why am I working harder today and having a less quality of life? It's because of the inflation monetary system that we have. But if we have a fixed monetary supply, life can get easier. I project from 2040 to 2050, the total store of value assets, again, money supply just growing at 8%. The CBO says it's going to double that. But at 8%, store of value assets go from 3.5 quadrillion to 8.4 quadrillion. I had to show you the history because you can't believe the future. Gold goes from 32 trillion to 52 trillion. Imagine that. Bitcoin goes from 289 to 1.8 quadrillion, now finally getting to 20% market share of the store of value assets. Because it's better in every way, and I don't have time to go through that. That's only representing a 20% ARR. Think about that. The S&P 500 did that this year, or last year, 2024. S&P did that. If S&P can do that, Bitcoin can certainly do that. That would put Bitcoin at $85 million per Bitcoin. And I just want to point out one more time, because my time's up, this does not mean that the dollar is worthless. People say, oh, but if Bitcoin's worth 85 million, what happens to the dollar? How much is a cup of coffee? A cup of coffee is $15. How much is a gallon of gas? $30. Doesn't mean the whole system has to die for this. It doesn't mean I don't use hotels anymore because Airbnb is here. It doesn't mean I only use Ubers or I don't use taxis anymore. It just means that it's taken a little bit from each one of those markets. And I think that's bearish. Anyway, that's what I got. Hopefully you enjoyed that. Thanks so much.